And hello, everyone. Welcome to the Real Estate Show on KCMX News Media 880 and on YouTube at realestateshoworegon.com. I'm Pete Belcastro. This is Alice Lima. We're both real estate brokers with John L. Scott in Southern Oregon. We get together with you once a week here on the radio and on YouTube to talk about our favorite subject, which is, of course, real estate in Southern Oregon.
Yep, it's absolutely our favorite. And it's so interesting and so diverse. There's so many layers to it. We could go on and on forever.
Well, fall is my favorite time of the year, over the year. And in real estate, it's become really, I think, a forgotten time.
Well, and it's interesting because it actually is, if you're a seller, it's a great time to have your house on the market because, especially this year, there's a backlog of buyers. But for a buyer, statistically, this is the best week of the year to purchase a home.
Yeah.
It really is.
Well, just to show you, again, we're in that cycle, just because we talk about the cycle. We're like, the summer was up here, which is June, July, and you can see it there as best you can. And it comes down. We're now here September, October. We've hit the line. We're at that median time of the year. So from here on, it's going to, it continues to slow a little bit, but also gives people opportunities as well. Guy Giles is here in the house with us today. He's our resident mortgage lending expert from Mutual of Omaha Mortgage. How are you doing? Nice to see you.
Oh, nice to see you too.
End of September. Can you believe that?
It's fast.
Yeah?
Every year I lose a little more hair and it goes a little faster. So.
Yeah. Well, tell us first of all what you've been doing. What's business been like in the mortgage lending industry? Because real estate's been pretty active. There's still a lot of closed sales. A lot of pending sales each week, new listings. So there's a lot of activity going on.
Yeah, and it's all over the place with us too. I just thought about that when you said it. Who I've talked to today, and I did a doctor and a diesel mechanic and a school teacher, so it's a little bit of everybody. Most of it does have to do with moving around. I think the economy's still really good. Obviously, we're going to get a lot of fluctuation in an election year. You'll have one side saying that it's doing great and one side that'll say that it's not.
You're talking about job relocation for people coming in and going out of the valley. Is that generally what you're saying there?
Yes, yeah. Obviously, I don't see as many going out of the valley because I'm not really on that end of things. Yeah. You guys would see more of that.
The selling side, yeah.
But yeah, it's new doctors coming into town. Always medical people coming here, and I'm still seeing a lot of that, and just people moving up. I guess 2 of those 3 are people moving up in their houses, all but the doctor.
Well, we talked about the medical thing. Remember, was it last week or a few weeks ago, we learned, that Asante is going to be building, last week when Matt Brinkley, the city of Medford planner, was here. He told us about, Asante's big new project they're going to do. So,
and it was just in the Mail Tribune today explaining some of those details. Okay. It's going to be a huge complex for oncology.
And that's going to be, as you call, about what it just does for real estate and the kind of activity that you talk about.
Yeah, and that's another thing that I'm kind of seeing, that people are kind of going under that umbrella too. I just did a loan for the lady over at Asante, and she's the new OBGYN, in charge of all that. And that whole thing is just, it's not really outsourced, but it's kind of a separate little unit that's all under Asante, and I don't really understand the relationship, but definitely a lot more medical just happening all over.
Well, it comes in and out. People move in and out. Specialists coming around. So that's a good, healthy part of the economy.
Well, and our population is growing too. Yeah. In fact, I think they're planning 2 more hotels. The Medford planner was talking.
Wow.
One at the South Interchange,
and then one over.
And
I think
one over by the airport.
Right.
So,
right. 2 more, not even there yet. Hotels.
Yeah, and I was at the legislative meeting yesterday, and they were talking a little bit about what this ADU thing will look like coming in. You guys might actually be able to speak to that a little bit more. I don't know if they're going to try to model it after what Josephine County just did, but somehow I'm trying to figure out how to fit everybody in here.
ADU, what are you talking about? What is that?
The new zoning?
Additional dwelling unit?
Yes.
Okay.
Yeah, and again, I'm not on that side.
You're talking multifamily. You're talking multifamily units.
I'm thinking about all the people coming and where they're going to live.
Zones.
Yeah.
Yes.
Well, when you figure that one out, you let us know, because we're trying to do that too, and nobody has an answer for that. I will say one thing, and with our show last week, and if you did miss it, you can go back and watch it at realestateshoworegon.com. We did learn a lot that I was really surprised. The city of Medford is pretty far ahead here.
They're very proactive
in trying to address some of those issues, and Medford is going to get hit, as Grants Pass will be, with the multi-unit units on single-family zones.
The new state of Oregon statute, yeah.
And how that's going to affect housing and lending and everything. We're talking small lots even in different neighborhoods and stuff like that.
Well, it's so funny. And just to think about what they're up against. That's one thing I heard yesterday, where they're saying that in some of these places where the house has to be half as big as the other house. So if you have a 1,000 square foot house people are trying to build a 2,000 square foot house and then saying that 1,000 square foot one was half as big as the other
Well,
one.
and some zip codes will let you do that, though.
Really?
Yeah, some Southern Oregon municipalities will let you do that.
That's kind of a weird thing.
It was.
That one.
Yeah, figured I'd bring that up because that was strange.
So what are rates doing? I mean, kind of what the ranges? I know it ranges from different things and stuff, but kind of just give us a general rate thing.
They're better if just as a kind of an overall thing. About a year and a half ago, they were, what, 5%?
Yeah,
we were just talking about that.
Yeah.
I'm locking people in, and it depends on credit and what program and a lot of different things. But at the end of the day, we're still in the either very low 4s, or I've had people in the 3s.
Well, a year ago, interest rates were predicted to go higher than they were. We were in the 5 ranges, and now they've come down, right?
And that was very unexpected.
Yeah, I mean, just it's an overall sign of just a world economy slowing down a little bit. I think we're still pretty strong as a country with the tax cuts that happened. I don't really anticipate a bunch of issues, but the trade wars. I mean, there's a whole lot going on that are affecting rates right now. But yeah, they were over 5%. We're down in the high 3s, low 4s at this point. Obviously, if your credit sucks, I'm not talking to you about that same conversation, but. Just in general, they're about where they were in 2016, but then they went way up, and then now they're down. It's all over. It's going to be very volatile for the next year.
That's just for like a 30-year conventional, right?
Mm-hmm.
Okay.
Yes. Yeah.
What about some of the others? What about USDAs? Are they still out there? FHAs, all those kind of things. What are those going for? The same rates? The same?
The government stuff is usually a little bit lower than the conventional are. I mean, there's drawbacks to them other than, just for instance, if you get a veteran's loan and you don't have any service-connected disability, there's that funding fee that you have to pay along with it. So, that could be a potential downfall, but most people have a little bit of service-connected disability, so that's 100% financing. The rates are a little bit lower. Same thing with the FHA. They're a little bit lower than they would be, maybe a little bit closer to the mid-3s. Right now. And if you're paying points, that's another thing that we should really, talk about. I guess we could do that right now.
Okay, we'll tell people what paying a point means.
If you go on to Quicken's website, just for instance, Rocket Mortgage, the one that you hear all day long, they will advertise a rate. They are always charging a point to a point and a quarter. I've never seen them not charge that.
And what does that mean? They're charging 1 point?
Meaning, yeah, you could take the word point, throw it out the window, put a percent in there, yes. So if you're paying, you say you have a $300,000 house and you're paying a point, you're paying a $3,000 fee for that rate.
That's huge.
It is, and all of them will pencil out eventually paying points, but it's a matter of what are your goals with the house. If you're going to only be in the house for 2.5, 3 years and you're going to move up, which I literally had that happen last week. They said they were getting quoted some rate, but they were paying a percent and a half for that rate. Well, it's going to be about, I think it was 7 years before they broke even on that. And by break even, if you save $10 a month and you paid $100 for that, then it's going to be about 10 months before it pays itself back. So as more of a mortgage planner, I like to sit down with you and have those conversations about what your long-term goals are with the house. Are you going to turn it into a rental someday? You want it to pencil out like that. That might be the difference in putting 10% or 20% down on a place. So really, you just want to compare apples to apples when you're doing that sort of thing. So I only say that to say you might see a rate online or a rate someplace, and there could be fees that they're charging or points or both that you don't really see. So it's good to compare those. So if you're thinking, well, I just saw a rate for 3.4 online, that could be the difference in kind of what I'm talking about and what you're not. FICO scores are huge when it comes to where rates are, down payments. They're just well, these guys are in it to make a buck. The investors.
I understand that.
So you're saying that your credit score can help your rate then?
Absolutely, yeah. And a lot of times we can run credit scenarios and find out. Every now and then, my credit score was an example where it was what it was. And when I had pulled it or somebody had, we looked at the credit scenario thing, and there was just I'd been doing everything right or everything wrong, but there was really nothing to do. But usually we can look and maybe guide you, if you get to us early enough in the process where we can, just kind of look, and if we can help with that, then that'll help with the rates.
Because there are some exercises you can do, actions you can take short term to help a little bit, aren't there?
Yes, yeah.
In your credit,
in your credit score, yeah.
What would be something you could do?
Well, for probably the biggest one, which is about a third of your credit score, is keeping your utilization under about 30%. So if you have a credit card that's worth, or that you have $1,000 limit on, you'll want to keep what you owe on it about $300 or less.
Oh, I didn't know that.
And that's really big, and usually that's the fastest one that can do it. Another one is just making your payments on time. It sounds simple, but that is a huge one. If you miss a payment, they're going to see that, and they'll watch that kind of thing for a couple of years before it drops off.
Well, that's a long time.
A missed payment is one thing. A late payment's a whole other thing, but they still treat it the same.
Yeah, and you could have 30 days late, 60 days late, or 90 days late, and and then it goes a little bit deeper. And I don't want to go too weird on that, but really, if you have a credit card and even if that company makes you angry, it's be careful before you close it, because available credit again is a big part of your score. So you could close one down. Now all of a sudden you have a really old trade line that's gone off there, and all your credit looks new. So and you don't have as much available credit, so that's like a double hit. That could be potentially over 50% of where your FICO score is on just those two things alone.
Well, what is it? Something like 73%, I think it is, of sales require a loan.
Mm-hmm.
The others are cash.
Almost
but generally,
everybody.
That's a pretty darn high number of loans that have to be made.
And there's a lot of
time.
moving parts, so it really behooves people to get and talk to Guy ahead of time, so you have a strategy.
I love it even if somebody's saying, well, I'm not really ready for a year. I don't want to waste your time. Well, come in and sit down. And, the sooner we can get on this stuff, when you're in contract is not when you want to address these sort of things. So it is a good thing. And, like I said, if there's something we can do, we're not credit repair people, but we see enough credit reports where we can kind of, give you a little bit of an idea on what the best route to go.
And what's a good credit score? I mean, I'm going to get a really good rate.
Well,
what do I need to have?
I'm always happy when people have over 640.
Well, now that's just to be able to do a conventional loan.
Okay.
But in order to get the best rate, you really want a 740 or more. And now you're seeing them actually broke down at 760 a little bit. They're what are called just like pricing hits or little points where they are. And there's 660, 680, 700 and different investors, because I do look at about 30 investors when I'm pricing somebody out. Different ones have different breaks at this point, but in the old days it was like a 660, 680, 700, 720, 740. Usually once you get above 740, there's you can't really do much better than that.
Yeah. You ever hit that thing? You ever hit that?
I did a long time ago.
I was going to say, long time ago.
Before children.
Yeah. Well, it's pretty high scores.
I used to have a clean car before kids also.
Yeah.
Right.
I mean, the biggest thing is to be able to know your scores and to get pre-approved, and so we can start. I mean,
if you have a good credit score and a decent down payment, we're in the really low fours. I mean, if it's going to be a government loan, you're going to be. I've actually locked people in, this week in the threes. 2 weeks ago, I was in. I was almost at 3.2. It was crazy where some of this stuff was, and then we just had the worst week for rates that I can remember.
Because they went up like a week ago. They went everything went up.
It was crazy.
It was real weird.
It was 5 days in a row of 40, 50 basis points a day worse, and every 21 to 25 basis points equates to about an eighth in fee. So I don't want to get lost in it, but it'd be a couple $100 on a $100,000 loan, and you figure you have 5 days of 50 basis points. It was pretty ugly. I mean, it probably went up over 0.5% in fee. So that's different than rate. It would be what it would. I'm just going to go too weird into here, but
it's all right. What do I have to take to get for down payments today? Because that's always an issue with people, isn't it?
Yeah, it depends on what you're buying and what kind
things
of
like that. Well, tell me
I mean, with depending on your income, I mean, there are 3% loans. There are some grant programs out there with 3% down, that you can get the other 2%.
Talking conventional, right?
Yes,
right now?
yes.
Okay.
I'm talking conventional. If we can keep you out of an FHA loan, we do.
And is that because of the mortgage insurance?
Yeah, it is forever, especially if you have a good credit score. If your credit score is poor, then an FHA loan is the only way to go. They have, anytime you come in with less than 20% down, you have mortgage insurance on a loan.
Right.
On an FHA, you actually have it even above 20%. But at the end of the day, you don't want to pay that forever. It's all you're doing is paying money to ensure that we get paid. So if you default on your loan, then we're the ones that collect on the insurance. You don't collect on it at all, but you get to pay for it. So if we can get you into a conventional loan, that's always my goal. Unless you're talking 740, 750 or pardon me, 640, 650 credit scores, the mortgage insurance can be cost prohibitive at that point. But it's just a flat fee on the government loans. Okay. So no matter what your credit score is, it's just what it is. It might affect your rate a little bit for your credit score, but it's not going to affect that mortgage insurance. And I've seen swings where I've played around with the calculators, the difference in $350 a month and $79 a month, depending on your credit score. Okay. So it does affect a lot more than just the rate.
Yeah.
But 5% down historically has been, for no matter what your income level is, because unless you're under the median income, then you're not really allowed to do the 3% down. That was just made for first-time home buyers, and they actually did away a couple months ago with low to moderate income areas, which there was some nice East Medford ones that were just close to the freeway that were still considered low to moderate, that anybody with any income could still do, but they've kind of done away with that, and they're just going with the median income. So you're, $58,000-ish for a family, and to be able to qualify for one of those.
Yeah.
USDA is higher.
Yeah. Now, when I have FHA, and you used to give when we first started our show 10 years ago, Alice, Joe and I were coming there, they were all FHA loans. They were all government loans, right? Now you hardly even do them.
Well, it's true. And again, if we can get you out of there, and Fannie Mae and Freddie Mac have been able to come out of their hole a little bit too. They were pretty mired in this whole crisis with the mortgage industry and everything, and they've got a lot more aggressive because they knew that they were losing so much market share.
Business
all day long.
They're losing business.
Yeah. So at this point, they're a little bit ahead of where the FHA is right now. Someday, hopefully they'll get away with that mortgage or do away with that mortgage insurance for life. I mean, you're charging an upfront fee, you're charging that, and it's just like, leave it to the government to really help you.
Well, they took a great program and just kind of whapped it away by charging this mortgage insurance for life.
Well,
on the loan, it's crazy.
And the down payment difference between 3.5% for an FHA and 5% minimum for a conventional is not that much. I've noticed most of our buyers can scrape together that extra amount of money, and it makes such a difference for them long term, because later on the conventional loan, doesn't the mortgage insurance get taken off either automatically or at a certain preset?
Yeah.
Why don't you talk about that?
Automatically at 78%, it'll come off. If you've done improvements to your house, or or you can get an appraisal showing it. I mean, they kind of get that mortgage insurance for a couple of years, no matter what, and you can argue that back and forth all day. And I've talked to the mortgage insurance companies, I've talked to the servicers, I've talked to different people trying to get exactly what you can do. Always, if you fix your house up and it appraises for more, you can get out of it. Always, if you pay it down to where it's under that 80%, you're okay from that original appraised value.
Absolutely.
But definitely, it could be a gift from a family member as far as the difference for the down payment.
That's a great idea.
And Fannie Mae says that if you wire that directly to the title company, you don't even have to source it. So if you don't want your kiddo seeing what you have in your checking account, you don't have to disclose that if you wire it directly with a gift letter saying, hey, I don't expect repayment.
We got a break coming up here, and when we come back, can we talk about closing costs too a little bit?
Yeah, because every lender is different.
And down payments and kind of things, where they can come from. You said gifts and things like this, because so many people are confused by it. Of what cannot have, how much money do I have to have here, where can I get this kind of money? Because at closing, no surprises, right? I mean, and many times we're surprised. We're going to talk about that. Pete Belcastro, Alice Lima here today in the house on the Real Estate Show. We're with Giles from Mutual of Omaha Mortgage. We are coming right back right after this. Welcome back to the Real Estate Show on KCMX News Media 880 and on YouTube at realestateshoworegon.com. Pete Belcastro and Alice Lima in the house with you today on September the 28th. Wow, there's a lot going on in the real estate business. We're with Giles from Mutual of Omaha Mortgage. He's our lending, we call him our resident expert because, gosh, you've been doing this a long time, and you really see, like we do, you see the market. You see what's out there and what's going on.
Yeah, every day it's just a little bit different. But yeah, I don't even know how long have I been here.
It's just a blur sometimes, isn't it?
It's been a few years.
Yeah, we'll see what happens with it. What do you do with, let's talk about down payments. What do you tell people? Especially, I don't have 20, I'm buying my place. I'm trying to come up with 20%. I didn't want mortgage insurance. That scared me to death because it was so much money.
Yeah, a lot of people don't understand you don't have to have 20% down if you don't want to or can't, and you just have to talk to the lender about the mortgage insurance and qualifying.
And there are ways to deal with that too, especially if you have a really good credit score. We're looking a lot more towards the lender-paid mortgage insurance right now, where they don't actually hit you on your debt-to-income ratio for that mortgage insurance, and you can finance it in a lot of times. So say you have 95% loan-to-value, but you have mortgage insurance. Well, for financing in, on the last one that I did, I think it was like $3,200 or something. Yeah. That only made their payment go up. I think it was like $30 a month or something like that. But if they had mortgage insurance, it would have cost them about $120 a month. Yeah. So financing that in a lot of times is a really good way to not even have the mortgage insurance. And it's just a different way that the mortgage insurance have got a lot more creative.
So they're letting you put that in your upfront closing costs when you close? Is that what you're saying?
Yeah, well, it's actually, you could pay it as a closing cost up front, or you could just finance it in. So depending on your loan to value, I mean, it can't, I don't, if I get too far into the weeds, I'll confuse everybody, but just
simple.
Come see me and talk to me about it, because if you have a 95 and then a 95% and you finance in $3,000 or $4,000, you're not going into that next.
But it's all this money though that you're talking about bringing to
the
monthly
table. Payment.
Can I just bring it? Can I get a gift from my folks? Can I get a gift from somebody? Can I get tell me what I can and cannot bring to for my down payment?
Well, you mean as far as where it can come from, or what you can bring?
I mean,
So most of the time people have money. If you borrow it from like your retirement, it's something that we don't necessarily hit your debt to income ratio with. Talk to your financial advisor though, because if you're borrowing from it, even though you have money still in there and you're borrowing it from yourself, that money you're not growing, you're not getting any return on that money. Right. So anyway, it's one of those things that just goes a lot deeper. But family members can gift you money on the government programs. Your boss can a lot of times, interested parties. If you've been boyfriend, girlfriend for a long time, kind of domestic partners, you just kind of have to prove that there's that relationship.
But you only said government programs. So conventional loans, it's different.
Now I'm talking about bosses, but family members, different people can gift you money on
even
a
conventional loan.
Oh, absolutely. Okay. Yeah, it's actually a little bit easier sometimes because again, I'm going to go too far into the weeds.
But is there a waiting period or anything?
If it gets wired directly to the title company, there's not a waiting period on it.
That sounds like the
nice
key.
Trick. Yeah,
you send it directly. So if I had say my mother wanted to give me help, she should send it directly to the title company.
As long as it's wired straight there, and you'll have a gift letter saying, "Hey, I'm giving Pete this money because he was really cute when he was young or whatever."
And
he cleaned his room.
And that I don't expect repayment on it.
Do you see that a lot? Do you see
all
people do that? Oh, okay, so it's not unusual.
We do it a lot just because to help people make up the difference to get to the 5% down instead of 3.5%.
You do that, okay.
And again, that's why it's good to just come in and sit down with me, because we can talk a little bit more. I mean, if you just plug it in, you might be thinking, well, this is what I have, this is how to do it. We can look at a lot of different ways to structure something that might save you a ton of money. I mean, it was important for those last people where we financed in that upfront mortgage insurance, the payment-wise.
Yeah.
And it ended up helping them a lot. Now, when you go into closing costs, there's some distinctions there too, because there's what we call prepaids, and then there's closing costs. Just an example of what I did today for a veteran buyer.
Okay.
His prepaids were a lot more than his closing costs were.
His prepaids are like property taxes for the year.
Yes,
and insurance,
mortgage insurance for the year. They collect that up front, correct?
The mortgage insurance is just kind of financed in. That's a little bit of a different thing that we don't really see on the closing statement. I mean, you would see it on an FHA loan, but really with, to make it simple, you collect a few months of taxes. You want like right now taxes are due. So they want to make sure, the title company, that those taxes are getting paid. So just an example of the signing I was at right before I got here, they were collecting 13 months of taxes. So you're collecting your full year. Well, it looks like on your closing statement, wow, I'm charging a lot of money for this. when in reality we're collecting, about 14 months of insurance no matter what time of year, because you're paying that full year, and then however many months are due on the taxes. So, and then however many days of interest that you own that house for that month that you're closing. Like right now, we're kind of towards the end of the month, so he's only paying for 5 days or 6 days or whatever.
So it's calculated by the day.
Yes.
At the end. Yeah.
Yes, the daily interest. So what you wind up having is, on his example, about $4,200 of prepaids that were not really fees. But if you just look at that thing, you're like, holy moly, my total fees are $6,800.
Oh, yeah.
And, my whole bank fees are about $1,200. Then you have about $1,400 of title insurance on this specific example. You have an appraisal that you're going to pay, $800 on a VA. That's just a standard one, but we charge about $730, $740 on a regular one. So just little stuff like that. But your prepaids can be a whole lot more than your actual closing costs
and you
are.
have no choice here, right? On the prepaids, you got no choice, right?
Yeah, I mean, you don't have to escrow. You don't have to put that into an account. I mean, on VA loans, they do want you to. On, if you have less than 10% down, they want you to have that in an escrow account. But no, if you're coming in with a regular 20% down, a lot of people like to have control of that money themselves.
Yeah.
They'll want to make sure the insurance is paid up for the year, so you're still coming in with 12 months of that no matter what.
Homeowners insurance.
Yes.
You mean, yeah.
Yes.
Yeah.
And
All those have to be, those are the prepaids.
Yeah.
Yeah.
So, I mean, closing costs can get very convoluted, especially when you're dealing with the online lenders, because a lot of times they don't know that right now we're collecting a full 12 months plus, a month or two of reserves. So they'll send you out a quote and you're thinking, wow, my closing costs are really cheap. But in reality, you just have somebody that doesn't really know how to put together a good faith estimate for Jackson County.
For what it all comes down
And
to.
then you're going to get the surprise of your life.
Yes.
Have
because
you-
it
end.
will
Have
get
you ever
reconciled.
had people walk away from a deal because of closing costs?
I've had people change their mind about which home they were going to purchase because of taxes and the amount of money that was going to be collected up front, because when you start putting it together for a year or 14 months, it's a big chunk of money. We've had people change their mind.
I had a client come in and buy a really nice place that had like a $7,500 property tax with it. And you go into closing, and here's the prepaid, for the year, and here all of a sudden closing costs were like $20-some thousand, and you're just going like this, and so they have to be explained, and people need to know what they are. Because
Well, and they get them ahead of time now.
and
a
for
little bit,
people.
yeah.
Yeah, as far as that goes, it's not as much of a surprise, but it definitely can be when you're out looking, and that's why I always tell people also to call one of you guys as a real estate agent. You want to have somebody that's good, that's in your corner. I've seen two houses. I don't know if we have a second here, but right next to each other, both built, say, 1995. One of them's taxed at $120 more a month than the other one. Same square footage, same remodels. One guy decided to pull permits. One guy didn't pull permits, and your house gets reassessed if you pull more than $10,000 worth of permits.
Right, we learned that.
So I tell people just watch those taxes, because they can be all over the map around here.
Yeah, lots. Remember, they're reassessed. We'll hope to have the county assessor back with us as soon as it's tax season time, and we're gonna know what the valuations were for this year soon.
And also, I think for the ongoing projections of your payment, because your payment will go up if the taxes go up, if your homeowner's insurance goes up, and that's just how it is. It's not that your mortgage is going up; it's that the
taxes
and the insurance are going up every year.
And we can pretty much count on a 3%. That your taxes are going to go up every year, kind of no matter what.
Wasn't even Jackson County doing that during the crash for part of it? They were still assessing.
Probably.
Well, they're all going to go up 3% no matter what.
Well, now, because everything's great.
We won't blame you for that one, Dave, when you come in.
Yeah. No, I'm curious as to what we're gonna see for valuations this year.
Well, and then again,
I don't know.
We're still dealing with the assessed value versus the real market value. So they always try to artificially keep that a little bit lower so they can raise that.
Well, remember that real market value, which we're going to be receiving, was what it was on January 1st of 2019.
In the assessor's opinion.
In the assessor's opinion of what is a normal market. So those fluctuate and those change by neighborhood, by community, and things like that. But
and just events. We're in a dynamic market that's changing a little bit every day, and those assessments are static. We just have to keep that in mind. The other prepaid I wanted to mention is HOAs. Don't those have to be collected a year ahead, or do they?
they can't even collect them, right?
No, we don't. I usually don't mess. It's something that's a little bit separate.
HOAs can, if I understand this, I just sold a place that had an HOA, and the HOA is not part of the escrow. Mm-mm. They won't collect money for it, and they won't pay the HOA fee out of escrow even. I didn't know that.
We do hit them with that on the debt to income ratio. That is.
So it's part of the calculation for the pre-approval to make sure that you can afford that extra money every month.
And and that's actually a really good point, because I've had people come in. I actually had one this week that was a lady moving here from up in Washington, and she said she didn't want to pay more than $500 for an HOA, and I was thinking, holy mackerel, they better. I don't know how awkward it'd be to have someone in doing my laundry, but it better be included.
Golden blades of glass.
There better be a lot. And HOAs sometimes are really debilitating to people.
Well, they can be couple $100 a month or more.
Yeah, it depends where you're at, how much they do with it, or if it's if it's a condo, if it's whatever you're in, it varies, and you want to make sure that you know all those fees. And that's the bottom line here, right? There's a lot of different fees out there, and you want to know what they are before you start signing away.
And that's why having that consultation ahead of time with Guy is so important.
Yeah,
with me and a good real estate agent, like I said, I mean that's part of buying it. I see so many people that want to come in here and just do it all themselves, and why not have somebody representing you? It's
no, don't do it yourself. We've learned that over the years of doing our show here with too many people who sat here and we talked about that. Don't do that yourself. From buying on the courthouse steps on down, unless you know what the heck you're doing. What people can really get burned.
And you can afford, and you can afford to take the loss or deal with the damage that you've just been delivered.
You got enough money; it covers all ills.
Money fixes a lot.
It fixes a lot. We got one more segment to go today on the Real Estate Show. We're with Guy Giles from Mutual of Omaha Mortgage. We're talking a lot about mortgage rates and interest rates, pre-approvals, and on down the line here. You got to have it. You got to make a deal. You got to be able to get a great mortgage and a great lender as well. We're coming right back to the Real Estate Show here on KCMX and on YouTube at realestateshoworegon.com after this. Real Estate Show continues here on KCMX News Media 880 and on YouTube at realestateshoworegon.com. Pete Belcastro and Alice Lima in the house with you today. And we've got some great shows coming up, by the way, in the future. We're going to talk about packers. Things like that. Frank Mania from Ticor Title is going to be here. We're going to talk about commercial activity.
Yeah, he's great. He's got a lot to say.
He knows more. We'll learn more about hemp, I think, a little bit out there as well, and things like that coming up. And then we've got a show, which I think you're really going to find interesting, about ponds and water features, and how do you take care of your koi ponds, your water features in the winter, and what happens to them? How do you repair them? How many times do you see, you're showing property, this used to be a water feature, and it doesn't work anymore? Well, then don't tell me it's a water feature because I want it to work. You see, anyway, all those are still ahead. These are things that we don't even think about sometimes until you're stuck.
Or they leak,
Or they leak, and you're in an emergency, or what do you got to do, right?
Yeah. But everything can be fixed.
Right.
Honestly, the veteran that I was talking about putting those closing costs for, I was out there with the real estate agent because they wanted me to look at the house and make sure that it would finance, and there was a big non-working water feature out in the front, and I didn't even think about it until you just said that.
What do you do with them?
She had ideas.
Spend thousands of dollars on
we
them.
just had one get filled in last week, so I'm very current on that whole process.
I inherited one,
and I put them in, and they're lovely. Yeah.
And my neighbor across the street put a water feature in.
They're great, especially if you're in a noisy area. You can put that between you and the source of the noise.
Yeah. So I thought that was always because it was Italian. And Italians love water, like always have fountains, and so that's why I like hearing water. I think is my deal. Anyway,
okay.
It sounded to me like
strange how that goes.
Like Alice puts in water features, so if you buy a house with her, she'll put in a water feature for you.
or we can find them if you think you don't even know it's there. Okay, back to with Guy Giles. By the way, Guy is from a Mutual of Omaha Mortgage. We're talking mortgage interest rates. We were talking how historically, they've come down and they're great. I think as long as they stay in the range that they are, that is going to continue to drive our market because people will be able to afford those properties. And if they start going up and up and up into the fives, I think the whole train's going to get stopped.
But 5 is still not very high.
Historically, anything under 6 is a great rate. But you're right. It definitely deters buyers as it goes up. And again, just with the appreciation where it's compounding, on the house, I just think back to my house upon Hillcrest that I bought I guess it's been 22 years ago now. I thought I really overpaid at $137,000.
Oh my gosh.
Yeah.
You know, I'd buy 20 of them right now for that price.
Can't even find one for that price.
No, not at all. And it's paying out really well as a rental at this point. And, you know, and so again, it's really about getting in the game. So say rates go up from the time you get pre-qualified to the time you're done, and say it's just horrible and they went up 0.25%. We still have a house that what are we at 5.7% appreciation as a country, and we're probably I don't know.
Southern
where
Oregon's
we
a little
fit
better.
in.
I think we beat the national averages.
Yeah. So I mean, overall, you're still doing really, really good, especially the little bit that you might lose in a rate. And you know, a lot of times people just get bothered over the littlest thing, and you're looking at $4 a week is what it really amounted to. So, you know, really look at the big picture. You know, I always said mowing your own lawn sucks, but not as bad as mowing someone else's.
No, that's really true. What about investors? Alice deals with a lot, with investors in properties.
Non-owner occupied.
Non-owner occupied.
Yeah,
they got to come down with more money down, right?
Yeah,
generally?
I mean, you know, and there are some programs as little as 15% down, but you're just not going to get that good of a deal.
You're not going to get those.
Yeah, if you can come in with at least 25%.
25.
Yeah, I mean, you don't have to.
Okay,
don't get me wrong.
I understand.
But if you just look where Fannie Mae and Freddie Mac, and again, those pricing breaks, like I was talking about with the credit score, it's the same thing with loan to values on those. You don't really get hurt so much on conventional ones on the rate because they know that they're getting covered with that mortgage insurance as a second set of underwriting.
Okay.
You know, and they're just going to kind of get covered. But on the investment properties, that's where everybody walked away from, you know, during the crash. And the more skin you have in the game, the better deal you're going to get from.
You still deal with.
Oh yeah,
investors,
we
don't
have
you?
a lot of buyers out there right now for investment because with the new rent control laws in the state of Oregon, first state in the union, this year, February 28th, the statute was passed. There's a lot of older landlords that are getting out of the business, and so that's adding to our supply. And it's giving people more choices. And there's a new breed of landlord jumping in, willing to go along with the new rules.
More entrepreneurial people.
Yeah, because they really see a nice, steady way for a lifetime of investing to build wealth and have financial security.
Well, you talked about building wealth. In Jackson County, in the last 3-month rolling period, the values went up 4.9% overall, you know, so that's a good investment. You know, it's not in the double digits which is bad, but it's at a nice steady pace for investing.
And if you were the investor on that particular property, your tenants made the payment for you, and it's free money. It's passive income.
Even through the big crash, I mean, because I bought it before that, and I watched, and I just did the math on it because I can't help myself. But I still averaged 4.3%, and that was like 4 years ago when I had done it. So even going through the biggest crash since the Depression, I still averaged 4.3% year over year on that thing.
Right. Before we get out of here, people are refinancing still, aren't they?
They are.
I've just heard a lot of that. Appraisers are backed up because of a lot of refinancing going on. Is that accurate? Is that true?
I have probably more refinances in my pipeline right now than I traditionally do in 6 months.
Wow.
It is kind of a weird time. Wow. I have people calling me saying, "Hey, I want to refinance." I'm like, "What are you talking about? You know, we just did your loan." And then I like, send me your statement and I'll take a look, because I always want to make sure it makes sense. You know, the one thing you don't want to do is you've been in your loan for 10 years, unless you have a real need to have more money in your pocket every month. You know, you really want to look at that, because you don't want some slick guy like me selling you hey, let's just restart this amortization because you're paying all that interest again up front. So you really just want to look and see what your goals are. If you're retiring and you need more money in your pocket, then you know, that's absolutely valid. But if you're just doing it because some clown got you on the phone and said, "I'm going to save you $300 a month,"
it's really surprised me how many people are refinancing.
And if you are an investor and it makes sense because the rate is going to be low enough, then that's a great conversation to have.
And even for owner-occupied people. So don't get me wrong at all. I'm just talking about starting that whole thing over again. If you've been in your loan for a long, long time, it's not just about per month. I kind of try to look at it like, what's your overall thing going to be? And a lot of times the answer is go get that lower payment, take the difference or part of the difference and hit it towards your principal. And then a lot of times that's what really moves the needle, and then you can accomplish what you want to accomplish. Yeah. But lay off of that if you decide you want to, you know.
Paying down principal. That's a big thing, right? We would love paying down principal. Wish we could do it faster.
Yeah, and again, it has to do with your life strategy and how the asset fits,
well, that's what I've learned,
your overall goal.
Today from you, Guy, is that really there's so many different options for whatever kind of category you find yourself in, whether you want to invest or you want to buy something or, whatever, that you have a lot of options that are out there. But gosh, you got to be ready and prepared, because we don't want you to. The worst thing you can do, as we say this all the time, is to find the place that you want, but you're not ready. You don't have we're not pre-approved, or we're not ready to buy.
Yeah, you don't want to go out looking
because someone's
going
to come and take that from you, especially in the lower price range, where we're still seeing a lot of activity going on in the marketplace.
They don't last long, for sure.
They don't last long, no. And even as we go into fall, we're coming this way. There's still a lot of activity and some great deals to be had. Certainly, but you got to be there first, right? All right.
Yep. There's still some multi-offers out there.
That's going to do it for the real estate show today. Thanks to Brett Nance, our affable camera operator for today.
Thank you, Brett.
His support of today's show. Guy Giles, Giles at mutualmortgage.com is how we find Guy. You can Google him as well, and he can, of course, help you anytime with getting this information. Be a smart real estate consumer. Let Guy actually help you. You got a big week coming up as well. You've been busy, I know.
Always.
Always, yeah, he's good.
Lots of people need to move to the next step, so that's why we're here.
Showing properties,
listing, doing a lot of consultations.
All right, that's going to do it for us. You have a great week. We're back with you next week here in KCMX as well. YouTube at realestateshowOregon.com. Have a great week, and God bless you all.